Thank you both very much. A couple questions, no gotcha questions, trying to understand better. Dr. Zandi, you know, I was concerned about the recent statements by the new chairman about lower interest rates continuing far beyond, you know, the lower unemployment rates as well. You know, to a layman, it seemed as if the Fed simply wasn't moving the goalposts, but removing them completely. And we're almost to the eye of the beholder type of Fed policy going forward. So, one, do you think the market has, you know, anticipated the end of quantitative easing? Two, do you think the market has done the same for this near zero interest rate? I mean, are they starting to understand that this cannot continue? And then, do you think the market's given any thought yet to just the mortgage-backed securities and the excess bank reserves that will have to be addressed as the economy starts to take off?
Well, I think we can glean expectations in financial markets from futures markets. And if you look at what the futures markets are saying, the sort of consensus view in the financial system is that tapering will end by year's end, September, October, November, that interest rates will remain, short-term interest rates will remain at zero for, as they say in the FOMC statement, a considerable period, and Chairwoman Yellen has articulated that's roughly 6 months, and that's pretty much embedded in futures markets. And that interest rates will, short-term interest rates will start to rise in the summer, fall of 2015 and slowly normalize over time. So that's what's embedded in the financial markets, that's what's in the bond market, that's what's in the stock market, that's what's in currency market. So I think the Federal Reserve, at least at this point in time, has expectations in the financial markets right where they want them. Now, I do expect that the spring, summer growth will reaccelerate. I think the economy was temporarily weakened by things like very poor weather. At least where I come from, it's been, well, here, you know, better than anyone. And at that point, bond investors are going to start to anticipate an earlier tightening of monetary policy, pull forward their expectations, and we might see long-term interest rates rise. So the Federal Reserve, at that point, sometime this spring, summer, will be tested again, and this will be a very important test of whether the new chairwoman can explain some of the thinking behind, you know, the path she's articulated for future interest rates. But so far, so good.
And Dr. Taylor, two quick questions. One, why haven't we had significant price inflation? Do you think this should be a concern, a threat going forward? Can you hit that microphone, Doctor?
Sorry, Mr. Chairman. The economy has been quite weak. You mentioned that in your opening. So the usual kind of pressure you see that raises inflation has not been there. The second is this liquidity is staying in the banks for the time being at least, and so it has not leaked out to money growth as could occur. But I think going down the road, there's no reason to be complacent about this at all. It's kind of what you'd expect. If anything, you wonder why there has been even less inflation. But I think it's still a concern going down the road.
As a layman, my view, just listening to our businesses back home and then throughout the country, I always get the sense there is real uncertainty over increased regulations, including banking regulations in that area, and in uncertainty over fiscal policies and about the ability to invest now without repercussions later. And I sense, you know, the Fed has their foot on the pedal, go. I think the regulators have their foot on the brake for our banks. In addition to the lack of demand, that's part of the challenge we've got. Dr. Taylor, final question. I've introduced legislation to reform the Federal Reserve, and among its major provisions is to focus back on price stability, the single mandate versus dual mandate, and some other reforms. In past discussions, there's concern that should we do that, we somehow, the Fed will somehow ignore job creation in a disappointing recovery, or that it might not have the ability to react to a financial crisis in the future. Could you address those concerns for me?
Well, it certainly would have the ability to react. There's no stipulation that the Fed couldn't do its lender of last resort activity, so it would be completely unchanged. I think what is perhaps confusing to people on this issue is that when you look at history, it's the very extra focus on other things besides stable prices that has caused the problem and has even led to higher unemployment. In the 1970s, the Fed drifted away from its price stability goal and actually tried to address the employment issue. And look what happened. Unemployment went up and up and up and up. Then you had Paul Volcker come in, who changed that, focused back on price stability. And look what happened. Unemployment went down, down, down. And then recently, we have had this much discussion of the unemployment again. What happened to unemployment? It's gone up much higher. It used to be this. I was at this committee hearing in 1977, and Hubert Humphrey was in your position. And he was outraged that the economists were talking about an unemployment rate of 4.9%. That's way too high. And so we have had, unfortunately, a policy which has led to higher unemployment, even though the statement is to focus on it. So that's my concern about this and why I think a focused Fed, limited purpose Fed would work better.
Thank you, Doctor. Thank you both. Congressman Maloney?